Hello folks, Steve Lance here with Discover Options. Welcome to this edition of the Market Reports. It's December 9th, 2016. Presented material is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. We have two reports for you today. The S&P 500 Condor Butterfly Timing Report is for those of you that like to trade premium and sell premium from a market neutral perspective. Butters and Condors, they are advanced option strategies, and this report will help you time the entry of those better than just a seasonal report. The S&P 500 Directional Likelihood Report is for those of you more statistically oriented, and it helps us determine where the market is likely to go up, down, wobble around for a bit based upon the current market condition. Speaking of that, today we had another upswing bar following Thursday's upswing bar. The close, we are above the 50-day simple moving average. Now this is all creating a current condition, okay, that we're going to compare to similar times in the past where the market acquired this same condition. So this is how we're defining the condition. All right, price action, 2 straight upswing days. Trend, we're above the 50-day simple moving average. I'm throwing in there the notion that we've had 4 consecutive up closes, really 5, but I'm defining it as 4 for purposes of the studies. And then finally, the stochastic is in overbought territory between 70 and 99, and we are above the 3-day simple moving average, the percent D, so to speak. All right, so that all creates a current condition that's been replicated several times in the past, roughly 118 times total, something like that in the past, and we're going to take that and run with it. Okay, now just as an overview, oh, and by the way, let's just go straight to this. If you want to subscribe, please click on the button. That way you'll get noticed whenever we create another one of these recordings. That would be great. We would appreciate that. And also, if you want the free ebook that we have, please click on the link, and we'd love to get that to you. Jim Graham and myself, he and I co-authored this book, Simple Steps to Options Trading Success. We would love to get that to you. Now, many of you are familiar with the methodology behind both reports, so I'm just going to give you the overview and get right to it. And that way you don't have to stick around for all the methodology stuff because you may have heard it before. And I totally understand. So here's the report for December 9th. We have a current a positive edge for selling premium through Butters and Condors. So let's go through this. Since January 2000, there have been over 4,200 daily closes. Of these, 65.1% have been favorable bars for selling premium where the actual 21 bar movement was less than the SIBO skewed adjusted implied movement. Okay, 65.1 is our base. Also during that time, the current condition, just like what I showed you, and I'm showing you down here also, that's occurred 113 times. Now, some of those are consecutive bars like we see here. Consecutively, but 113 total times. Of those 113 times, 76.1% of the bars have been similarly favorable for option premium selling. 76.1 is 11% higher than the 65.1, and so that gives us an edge of 11%. Okay, so 76% of these 113 times have been favorable for selling premium through Butters and Condors. So statistically, it's more likely than usual, usual being 65.1%, that today's bar will end up being favorable for market neutral option premium selling. So we have a positive edge in this regard. Now for the other report, let's go to it. And again, we're going to continue on and go to the methodology behind this, but let's just give you veterans an overview. Lots of red numbers here. This is a picture of lower market volatility. All right, now it doesn't guarantee, of course, that the future. Last week we had a picture of lower volatility, but at least in the ensuing 5 days, we had a lot of volatility to the upside. But when you look at the past, and we're looking at 79 non-consecutive signals here, of those, you'll see a lot of red numbers where the volatility bands were struck far less often than on the baseline. And then, as well as if the if the market exceeds Friday or today's high, we have similar red numbers as well, where it's hitting the bands far less often than the baseline up here. And then if the market goes below today's low come Monday, well, the upper bands are certainly struck less often, and then but the lower bands are struck about the same as the baseline. So all in all, a picture of lower market volatility. Okay, the same holds true for the skew adjusted VIX, a picture of lower market volatility, as you can see here. Okie dokie. All right, let's get right to the methodology here and go right to it. So that's for the veterans. Now, let's go into the details and get into the weeds as to the methodology behind these. This is the same presentation we give every week for those of you beginning and are just learning how we like to view the market from the perspective of butterfly and condor traders. Let's go over why we look at this report, the methodology, and then the current condition and edge level. So here's an example as to why you'd want to pay attention. Back on December 31st of 2015, the market had been chopping around for a bit, and you may have thought about placing a trade, a butter or condor. And if you had run it through our algorithms at the time, you would note that there was actually a negative edge going into this. And what that meant is that there was at the time a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. There was a negative edge, a higher than usual likelihood that the market was going to be more volatile than what was implied by the option prices. And in this cherry-picked example, boom, the market did get very volatile on the downside. So it just illustrates the notion that this can be predictive, but it's all about statistics, folks. It's all about odds and probabilities and statistics and money management, and we all know that, because I know I'm speaking to advanced traders. So let's look at this current condition, and here's the question on the table for this particular report. Is this current condition a good one for selling option premium through range trading condors and butters? All right, that's the question on the table. Here's how we answer it. We observe how much the market actually moves from a close. We call that actual volatility. Then we observe what market move is predicted by the option prices. We call that implied volatility. We compare the two in hindsight. So we'll go back to a bar, look at how much it actually moved, and then we look at what the options were implying at the time. And then we label that bar favorable or unfavorable for selling premium. So let's give an example of this. Here, let's look at actual volatility first. Here we have a close, and we look forward 21 bars and to see how far the market actually moved, whether it went up or down, the farthest distance it went. Here it went down 50 points, works out to 2.4%, which we can easily log in an indicator down there. Now the question here was, what market move was being implied at the time of those option prices, or being implied by the option prices at that time? We know it moved 2.4%. What move was being implied? So we have to go to the VIX. Okay, this is the S&P 500, so we go to the VIX. The VIX was implying a move of 4.4%. Yet it only moved 2.4. So that bar was a favorable bar for trading a condor or butterfly. You would have sold premium that was implying a greater volatility level than what actually took place. So we would paint that bar blue. Boom. We would paint it blue. Okay? And then for those bars that turned out to be here, let me move this thing over. Okay, so we paint the bars blue. Let me move this up here. There we go. These blue bars had situations where the VIX was implying a move greater than what actually took place. These red bars were unfavorable for selling premium because the ensuing volatility was greater. The ensuing move was greater than what the VIX was implying at the time. You could see down here we're plotting the move implied by the VIX, the blue, versus the red is the actual volatility. Okay, now we have to always look at this in hindsight, so we have 21 bars here that we just don't know yet if they're going to be blue or red. Correct? Got that? All right, so now, historically, what percentage of all the bars going back were favorable? Okay, we're going to ask ourselves, out of the 4,200 plus closes going back to January 2000, our baseline, our benchmark, is going to be determined by what percentage of those were favorable. Then we're going to look at the only the bars that match our current condition and ask ourselves what percentage of those were favorable. And then if there's a big difference, then we'll see if there's an edge. So as it turns out, 65.1% of all the bars going back to Jan of 2000 were favorable for selling premium neutrally. 65.1. Now, of the bars that match our current condition, what percentage of those were historically favorable for selling premium? If we go back and find out all 113 were blue and favorable, wouldn't you be more apt to put on a Condor or butterfly right now? What if all of them turned out to be red? Well, then you would definitely want to back off the notion of selling premium with Condors and butters, right? So let's take a look. As it turns out, 76.1% of the bars that match our current market condition turned out to be favorable. Now, what does that mean? That means that we have an edge of 11%, 76.1 minus the benchmark of 65.1. So there is a higher than usual likelihood that the market will be less volatile than what is implied by the option prices right now. Okay, so that's the report. All right, so you do have an edge. Does it guarantee that you're going to have easy time with your butter or Condor right now? No. You still have a 23.9% chance that you'll run into some rough waters. But of course, you have a good way of trading your butter and Condor. You have a good adjustment approach. I'm sure you've been to, you've done your homework. You've been to some mentoring programs. If not, consider Discover Options mentoring, because we will show you how to trade those and adjust the positions, and you'll know exactly how to manage it once you take our course. So that was that report. Okay. Now, before we get to the statistical report, likelihood report, I just want to make sure you understand Discover Options. We have a great curriculum for you to go from a beginner to an intermediate to an advanced options trader, even one that can manage other people's money. We have money managers coming to us for assistance in this way, and we've helped a lot of people trade options in an advanced fashion. So we have a set of professional option traders that cut their teeth on the floor of the exchange, managing money now. So give us a look, call us up, talk to our reps. We'd love to hear from you and create a curriculum that really matches where you're at and where you want to go. Here's the report, this market likelihood report. I'm going to explain all these boxes and exactly what they mean so you'll have a complete understanding. Here's the current market condition again, and here's the question on the table that this report will answer. Since Jan of 2000, how often has this same condition occurred? Okay, the definition you see. And what did the market do in terms of direction and volatility? Okay, and we're going to have about 79 non-consecutive incidences of the condition we're in now. Of those, if we go back and find out of all those 79, all of them, the market, what ensued was that the market went up dramatically. Well, we're going to go bullish in some fashion. If we discover that the market consistently dropped, we'll go bearish. But usually is not that not that easy. So let's just take a look at how we go about doing this. Here's what we do. We understand the historical distribution of price From every close, we're going to understand what the price does in the ensuing 5, 10, and 15 days. We're going to define that for us. Then we're going to look at the distribution of price after our condition developed. What did the market do for each of those 79 incidences that it matches our current condition? If we find that there's a huge difference between the benchmark historical distribution and then what happens when our current condition popped up over the course of time, I mean, if we find out that, yeah, well, I already explained that. If the market went up or down, I mean, we're going to just take a look at this. The potential edge can exist if the two are significantly different. Here's how we do the distribution of price idea. What we do is we take volatility bands, and I measure these bands are measured from each price's close. We go out one standard deviation in 5, 10, and 15-day increments. We use a 20-day historical volatility to determine the width of the bands, and these are log-normally distributed, of course. Here's just an example real quick, and this example is for 10-day bands. So we got the close here. We're going to go out one standard deviation to the downside as well. It's a 10-day measurement. And we're using the previous 20 bars to figure out the volatility that goes in for this input. Okay, the 20-day statistical volatility. The question is, in the ensuing 10 days, 10 bars, did the market go up and hit the upper band? Did it go down and hit the lower band? Or did it wobble around and not hit either band? Okay, let's look at what happened. Went up and hit the upper. So for that close, we record that it hit the upper band. Now, let's take a look at this close right here. Okay, we have the upper band going out 10 days, the lower band going out 10 days. Let's see what the market did then. Boom. Now, if you look carefully, here's where the lower band is, and the market failed to hit that lower band. So for that close, we record that it hit neither band. So what we do on our historical distribution is from every close, for every close, we record how often price struck the upper 5, 10, and 15-day bands, both the upper and the lower, 6 total bands that we're measuring. And then we record that, and here's the recording that we have for the last 4,230 occurrences, going back to Jan of 2000. Okay, price struck the upper 5-day band 29.3% of the time, the upper 10-day band 23%, the upper 15-day band about 23%. Now the lower bands, it hit the lower 5-day band 29.6%, lower 10-day band 29.4%, and then 32.2% on the lower 15. So that is the benchmark price distribution. All right, got that? Now, what do we do next? We're going to understand the distribution after our current condition occurred in the past. Okay? And then there's an edge that exists if the two are different. So here you have, I'm showing you just incidences when it occurred. And we're going to look at the distribution of price at the close, from the close. We're going to look at the distribution if price goes above, if on Monday price goes above Friday's high, what's the distribution if it does that? What's the distribution if it goes below the low? So we're going to cover all of that, so that gives you a good idea on what to do come Monday. Take a look at this. As of the close, 79 occurrences. As of the close, now those are non-consecutive. Price struck the upper 5-day band 10.1% of the time, so there's a 19.2% difference from there. It struck the upper 5-day band way less often. Struck the upper 10-day band only 15% of the time. Again, a negative number there. That's a difference between that number and that number. See that? Then on the 15-day band, slightly less often. On the lower bands, price struck the lower 5-day band only 16.5% of the time instead of almost 30. 13% difference. Big difference on the 10-day band and a big difference on the 15-day band on the downside. So what you see here is a picture of the market striking the bands way less often than on the benchmark here. All right, so that's a picture of lower market volatility. Does it guarantee us that the market won't go crazy and go way up or way down more than a standard deviation? No. We can see that it did that roughly 10 to 20% of the time, but way less often than over here in general. So it's all about statistics and just understanding what a possible edge is. Now, if price exceeds the Friday's high, if on Monday it goes above Friday's high, similarly, you have lower numbers, only 48 occurrences. And then down here, if price exceeds the low of Friday, then the upper bands are certainly struck less often. And then the lower bands are struck about the same, which makes sense. If the price goes down, after all this moving up and up and up, we're in overbought territory, and now if it penetrates Friday's low, we're not too surprised that it's going to go down and hit the 1 standard deviation, 5, 10, and 15-day bands, the same as the benchmark pretty well. Not too surprising there. Okay, now what I like to do sometimes is adjust these bands to reflect the skew adjusted VIX. So instead of looking at the last 20 days of volatility to determine the width of the bands, I like to use the VIX. The VIX is typically higher than the statistical volatility, so the bands are going to be wider. And from a benchmark perspective, you'll note that the bands are getting struck less often. Because the VIX is higher, the bands are cast farther away. Now the upper bands are using a lower volatility than the lower bands. And that's because we are skew adjusting this using the SKA, the skew symbol from the CBOE. Okay, so these are asymmetrical in that sense, because volatility is asymmetrical, right? The market goes up in a less volatile fashion than it goes down, and that's what the bands are reflecting. So still, we have red numbers pretty much across the board here, reflecting a picture of lower market volatility. Doesn't guarantee the market that won't go crazy, but it's showing us that historically it goes crazy far less often after our current condition is developed. Got it? Okay, so that's it for that report. Trading idea. We love this strategy called a hedged bull put spread. Here's what it looks like, and what I'm doing is I'm taking the skew adjusted VIX figure of 12.9% on the downside, and we're going to plug that into option view right up here. Okay, click that S button, bring up the standard deviations, use 12.9, that's the skew adjusted VIX. You know, the at the money is at 9.4, but when you skew adjust the VIX, we're at 12.9. That puts the standard deviation down here. Now I skipped a whole bunch of strikes right here, you'll note. What we like to do is a bull put spread down here, a full standard deviation away, 20 points wide, and then do it 5 times, and then we can purchase a 1 lot at the money bear put spread to hedge that trade. We still bring in a positive cash flow. We want to make sure we bring in enough down here to more than pay for that hedge. The idea here is that no matter how much the market goes up, we're going to make that amount at expiration. And if it goes down, well, then that hedge is going to kick in and make us more money, assuming the market doesn't keep going down a full standard deviation. So here's how it pencils out from a graphic analysis perspective. Market going up, we still make our 4% yield on a Reg T basis. If the market goes down, we make money on the hedge plus the credit we're bringing in for that spread in the distant puts. And if the market does keep going down below the short there of that bull put spread, well, then we can start losing some money, probably a good 1.5 times what we would make if it stopped short of that. Okay, so also finally, when you go to the price chart and use the little profit region button, you'll see that it looks pretty darn good. The market would have to go down dramatically from here for us to get into the red. If it wobbles around at all or keeps going up, we're looking real good there. Okay? Folks, I'm Steve Lentz with Discover Options. Again, give us a call, shoot us an email, and we'd love to hear from you. We'll be back next week, same bat time, same bat channel. Take care. Bye-bye.